You're listening to the Unmitigated podcast, the podcast that brings to light the hidden risks business owners and entrepreneurs take every day that may not be covered by traditional insurance. Here's your host, Van Carlson.
Hello, welcome to Unmitigated, the podcast. Van Carlson here, founder and CEO of SRA 830MB Admin. We have Stephanie Forbes here today. She's one of the brightest person I know in insurance.
Oh, thanks.
Yeah, very much. In fact, Stephanie gives you two cards when you go there because she has so many acronyms on the back. I think don't you have every one that you're capable of getting?
No, not even close. There's dozens more I could get. Yeah.
Oh, really?
Yeah, tons more. Yeah.
Well, anyway, I would consider Stephanie an expert when it comes to traditional insurances. Some of the things we're going to talk about today, the macro captive world, and kind of get people up to speed a little bit how that works. But other than that, Steph, you want to tell us anything about yourself?
Oh, golly. I've been in insurance for 36 years. Started out kind of in the personal insurance, the smaller side of things, and moved into commercial and just loved it because there's so much to learn. Such broad horizons when it comes to commercial. There's so many things people do, and trying to figure out how to cover everything is very interesting.
Yeah, it helps us too at SRA over here too. Same things.
Yeah.
No, it's so true. It is fun helping business owners, especially deal with the risk management strategies or nobody reads an insurance policy like you.
Nobody reads an insurance policy. That's what I've learned.
I make a joke. If you can't sleep,
right,
it is a perfect
pull out
thing
your
to go
insurance.
read.
Yep.
It is dry.
Yes, it is.
There's not a big plot in those things,
Right.
But no, they're pretty dry reading for sure. But that being said, the devil's in the details when it comes to insurance.
It's a contract. People don't think about it that way, but it truly is. That's a contract, and when something happens, you have to read that contract to discover, do I actually have this coverage? It's built into that.
Well, more importantly, who's writing the contract?
Exactly.
It's pretty one-sided majority of the time. You don't get the red line in an insurance contract.
Right.
Right? Like, I don't accept that one. But so that being said, we've talked about it for a while. I think traditional insurance does a good job for what they're tasked with, right? For the most part. And I think, it is what it is.
Mm-hmm.
They love things they can see, feel, and touch, right? Hard assets and all that good stuff. Overall, though, just talking with you, we've been working together for years, but just recently, I would say in the last 12 months, you've brought more things to our attention about exclusions coming in.
Yeah.
What do you think? I tell people, I started in 96, so we're coming up, what is that, 30 years?
Yeah.
30 years, 30 years, not 40. Oh my God, I almost said 40. 30 years. But man, I would have never guessed some of the things that's gone on in the last couple of years in the market.
Yeah. Insurance is built for the masses, right? So a lot of it doesn't fit everybody. It's not
one glove fits all kind of mentality.
Yeah, it's not. And so now that we're seeing insurance companies tighten the grip on that, they're taking away coverage that people are used to having. So because they're not wanting to cover these unexpected things that they weren't. We've got AI coming out and all these, things that they just don't quite understand yet and don't have a feel for, don't have the ability to predict losses. So they're tightening things up and trying to exclude what could possibly be massive losses.
I think you get in the beginning, they kind of would shoot from the hip more. Meaning that they'd go, they saw a risk, emerging risk. Hey, let's throw a policy around it. We'll figure out the pricing later. Yeah. It kind of felt like that in the beginning.
It did until Y2K, and then it's like we're excluding anything to do with computers or anything.
For all you guys that don't know, when year 2000 hit, the end of the world was happening.
It was, yes.
Somebody forgot to change the dates, and they thought, oh gosh, the computers are going to zero out. We're going to,
not going to have power, not going to be able to run cars.
You remember
it was
that's
crazy.
A lifetime ago, but the Y2K, holy crud.
Yeah.
Anyway, that was a big. And in insurance, well, we can't. We got to start excluding,
right?
Because we don't know the loss,
right?
I remember talking to an underwriter one time that helped underwrite oil platforms, offshore oil platforms. And they said, we had no idea.
Wow.
Because until one goes, you don't
Right.
know the
What to
catastrophic,
expect.
until the PP one fell. And of course, they completely way underwrote the risk of that and the premiums and everything else. But it was kind of interesting. They said, we had no idea. And, honestly, with technology today, too, I think, with AI and everything else, predictability is probably becoming more of a it's always been a science, but it's definitely
Right.
been more predictable, if you could say that. But, I think, which also tells them we shouldn't even step into some of this stuff.
Right. Right.
I mean, look at some of the exclusions. I mean,
Oh, yeah.
I think it's interesting, you get into these contracts that you got to perform a certain way, either through building a building. Now you got banking institutions requiring certain requirements of you to have certain coverages.
Right.
Franchisors that have a fleet of attorneys that have written these franchise agreements that says you got to have all these coverages in place, and it's making it very difficult to even honor the contracts in between parties because you can't acquire the insurance you need even to honor the contract you just signed.
Right. Right. So
Yeah,
the
I've seen a lot of
contract,
that.
you're taking in a lot of risk that you don't even realize is not included in your policy, and it's contracted. So you're stuck with that
Exactly.
no matter what.
And I don't know if I don't know how banks come off of their requirements, because they got to do it for
Right.
their own solvency. There's a reason why they're in the. Well, you hope there's a reason why some of these things are in. But even like capacity, right? When we talk about capacity, we talk about how much is insured, how much can you insure the building for, versus what they're borrowing.
Right.
The big issue used to be land, right? Well, we're not insuring the land; we're insuring the structure. But the banks wants, the land might
They
be
want
worth
to cover the amount of their loan, but 30% or 40% might be
Yeah,
just
we've always
land,
had those
so.
issues. Now
Right.
you're talking about these finite clauses in the contract that you're not going to have coverage for a lot of this stuff. And then you get into ACV. A lot of these, it'd be interesting to know how many banks are sitting on policies they at one point had replacement.
And
they just have a
because
continuous.
the roof has gotten,
the
more
wording
than
change.
15 years or,
Yeah.
yeah.
Yeah, I just wonder how many of them are exposed. They don't even know it.
There's probably a lot. Yeah, we
Yeah.
see it. I every day we see people come in with a copy of their policy and they didn't realize. We'll explain to them, and they had no idea some of the things that were missing.
Yeah, and we deal with that too, obviously. And well, that's why we have the relationship we have. You have the ability to say, hey, there's a way to deal with this.
Right.
You're self-insuring now. How do you want to do it, right? How do you want to be more proactive on it? But do you think, obviously everybody's felt the increases. So it would be fair to say you're paying the same, if not more, but getting less in coverage
True.
across the board.
I wouldn't say paying the same either. I mean, as we've seen over the
Oh
last.
yeah, I don't think anybody.
Yeah.
You're right. Nobody's paying the same. Yeah, everybody took the rate increase, paying more in the policy, but getting less coverage in the policy
True.
at the same time, and that's pretty universal.
Yeah, it
you know
is. It is.
Yeah. Do you see that changing?
No, we are seeing pricing start to level out a little bit until, we see this next year of catastrophes that might affect things. I don't think
Yeah.
people understand the reinsurance market and the fact that their insurance company is also insured by another insurance company, and then those prices worldwide for things that have happened get passed on to the insurance company, who then just passes it on to the consumer. So they don't understand that fully. So there's a lot of things that can affect the policies, not just the fact that the insurance companies lost investment income, but they're getting huge jury verdicts and social inflation, and it costs more to fix your car now, and the parts and the labor. But then when you have
there's nothing. I mean, we talk about commercial insurance, obviously, but there's personal lines are feeling it as worse, if not,
right.
even from a coverage, ability to get options for different insurance carriers.
But businesses, their auto insurance is incredible now.
Yeah.
The amount that we're seeing per vehicle is at least doubled, if not tripled, in costs over the last probably 15 years.
Yeah. Oh, I know. I feel it in my own portfolio of
Right.
stuff. But yeah, so when it comes to the traditional markets aren't changing, and then you got your good actors and bad actors, right? I mean, you got your ones that take risks serious. They're along for the ride with the people that don't take their risks serious. They're not being proactive on safety meetings or running good MVRs, hiring right employees to drive their vehicles.
Return to work programs for work
comp.
Yep.
I mean, being proactive in all that, and there's ones that are just shooting from the hip,
Right. And they're subsidizing those bad actors.
Yeah. Do you see, this is where we see the ability to replace traditional insurance. So just for the listeners here, Stephanie specializes in the ability for an insured, I would say a large enterprise operating company, significantly spending a lot of money in traditional insurance. That's everywhere from work comp, general liability, commercial auto, property, and excess risk, right? So those are a combination of, and what do you think? 400, 500,000 starts to make where you at least ought to start looking at it?
Yeah, I mean, we do have some preferred programs that are what they call a group captive that we'll talk about here in a little bit that can start at 250,000.
Okay.
But most of the ones that we see that are larger, we see usually in the $1 million range in premiums to be able to package a lot of those different.
One line could be more
true.
Being a big one, yeah. So for listeners out there, so we get this question a lot, and I think you do too. Hey, my rates went up, and they own 3 or 4 restaurants. It's painful, but you're paying $100,000 for traditional insurance. Granted, you were paying $50, pre-COVID or right around there,
right.
But now you're paying $100. I mean, you still wouldn't. I feel for them, but it's still, there's not a program out there that would make feasible sense for them to take the amount of risk they're taking relative to the reward they would get. You and I would probably tell them don't do it.
Right. And most of them don't have the capacity to take on a large chunk of a loss themselves. They have to pass that off and risk transfer it to an insurance company.
Yeah. You got to go along. You are going to subsidize that. It still doesn't get you away from the idea of still not. You should still be being proactive when it comes to your risk management strategies, right? I mean, even regardless of what level of premium you're at. But that still doesn't mean you're going to qualify for it to completely eliminate your own insurance and go self-insured and deal with what you do is the reinsurance markets, where you're going to go out and, you're going to take on a larger first dollar loss per se, but then we're going to have a stop loss basically, kind of like self-insured health insurance. That we're going to have in case there's a runaway claim or you have all that kind of stuff. So you do that, and that's what you're kind of, and then we do the group captive where you can bring down the lower amounts. And is 250 aggregated between all lines?
It can be. It just depends on the program. They have a lot of different programs for those lower risk, predictable type loss businesses that can do a smaller premium. Prefer 500,000. That's typically where they see the most benefit. But there are definitely some, and I'm working on some right now that are in the $250,000 to $350,000 range.
And if they got the risk tolerance for it, I mean, a lot of this comes down to the client, right? How sophisticated is this client? How do they understand, the pros and cons of this thing? And all of them will tell you yes. They're not afraid of risk. It's kind of like being in the investment world. You know what I mean? Where oh no, let's put foot down and give me 20% returns. Well, do you understand you can lose 40% then?
Exactly.
You know what I mean? It's like, there's winners, there's pros and cons to everything. And and sometimes I think people, I saw it a lot in self-insured health insurance where guys are like, oh, I'm taking on more risk. I'm just too expensive. And then boom, they have a bad underwriting year. They're like, oh God, I shouldn't have done this.
Right.
And do you see that? Have you seen that in your captive space?
For the most part, what we've seen is when we have clients that move into the captive world, they tend to see their losses drop by about half. We'll have a lot of them that are like 40%, and the average running in the group captives right now is 20% losses. That's not to say you're not going to have a bad year, and we do see it, and they can get assessed, is what it's called, to where you didn't quite, meet your funding that you needed. And you're gonna have to... the nice thing is they'll usually give you like 3 years to pay that back into your fund.
Right.
So.
No, yeah, and so when you, what do you attribute the drop in claims though?
I think because when they move into a captive, they realize right away my money is definitely at risk, but they also have resources. They'll have loss control resources, especially like I said in the group captive, and we have also access to some resources for risk control that they can put in place that will help. And they look at those losses that could be frequency issues and start reducing those as well as any severity losses. And kind of watch out for them and help themselves, put things in place.
Do you, given the current market and everything else, are you seeing, it feels like you are, seeing more potential clients slip into a captive's more of the answer for them?
Yes, and we're seeing, a lot of them didn't know that was available, but it
Yeah.
is definitely coming up now. A lot more people are hearing about it, passing on the word, referring people. So yeah, we definitely are seeing that.
Yeah, I would say that with our strategic partners, they're running more and more into this.
Mm-hmm.
Do you think there's a mindset with the producer side, the agent side of the business, where they're maybe not wanting to bring these kind of solutions to their business owners? I mean, even though, and some of it is self-awareness, even for insurance agents.
Right.
They don't know, it always surprises me when I run into a CPA that doesn't know about 831B
Right.
tax code.
Yeah, they don't know what they don't know.
Yeah.
Yeah, I think that a lot of agents are scared of it just because of not having the knowledge, not understanding it, not knowing how to guide that client into that. Once they learn about it, I've seen quite a few agents that are pretty interested now.
Yeah, I think they're looking for an answer to the problem, right?
Because if they don't, somebody else, another agent,
that's
will
the way I
bring
look
it to
at
their
it too.
client.
Yeah, I mean, education, and you work with those folks. You work with other agents
We
around
do,
the
yeah.
country.
We can act as a more or less MGA and work with the brokers.
Yeah, and you're willing to educate
Yes,
and bring people up to
absolutely.
speed and say, hey, this is, they don't need to be an expert at it. They need to be they need to have a basic knowledge of it, but the integral details of it and the underwriting that you have to fill out, the underwriting out, and the people you talk to, they don't need to do that heavy lifting because that can be years in development before, and even who to even call, right?
Yeah.
You got that knowledge. And so that's good. I know we refer a lot of our SPs that, because we'll get the calls and says, hey, yeah, getting back to the restaurant owner that's paying $100,000 right now. It's like, well, we can't really, but we have other issues that we can solve for you on the self-insured side.
Yeah, and if they foresee a lot of growth, we can start working
Right.
on programs that will help get them to that captive.
Yeah, that's when do you have a risk management program in place? Do you have continuity going?
Do you want to take on some higher deductibles now to start building that, ability to be able to?
And then we can and the 831B can obviously be a complement to all of that arrangement moving forward. Yeah, that's why it works so well.
Yeah.
Yeah. So we've handled the agents. I mean, I do think it is the problem about P&C agents, I'm not going to say this because I kind of feel like I still am one.
And I am too.
They're not the most proactive bunch.
Mm-hmm.
Right?
Right.
I mean, they were told to go out and build your book. 10 years, 15 years later, if you worked your butt off and hustled hard, you could hang out and work on your handicap. Right? I mean, that's what I've been witness to.
A lot of them will pass off to an account manager and not even talk to the client again for many years. So, yeah.
We've all seen it, right? For better or worse, right? So when they have ideas like this coming in, it's like, oh, geez, I got to retool, I got to retest, I got to rethink about it, But what's funny is, I deal with it all the time. As business owners, we do outgrow. As your business grows, you just have a natural tendency to outgrow your trusted advisors. Not as your trusted advisors grew with you.
Right.
Right. And I do think a P&C, property and casualty agent, should be a trusted advisor. It should be.
Absolutely.
Whether or not that's looked upon as the owner is really how the property and casualty agent presents themselves to the owner. Right. One of the things I always hated as property and casualty agent was, man, I love you. You're a good guy. But every time I see you, you cost me more money,
Right.
And I hated that.
Yeah.
Because I'm a business owner. I wouldn't like that. I'm like, hey, man, I'm going to avoid this guy. I don't every time we see It's like avoiding your attorney. Every time I talk to the attorney, I hear a little button in the background. He just sending me a bill for a 5-minute conversation.
Yeah.
And that kind of feels that way a little bit. And I think that's one of the things that some P&C agents, if they're resting on their laurels from their past work and everything else, I mean, it's going to get eroded. I mean, it just does naturally anyway. But more importantly, some of your top tier clients, they're going to attend conferences. I mean, we speak at a lot of conferences now. I think you owe it to yourself, not only from a professional standpoint, but also the clients that you've grown to know and trust, and they trust you to bring these type of ideas to the table.
Right.
And I know you feel the same way.
Yeah.
And you've been very proactive in that in your profession. So that's, I do think, I would imagine you would say this, that, it's just going to get bigger and better all the time. This is going
absolutely.
nowhere.
Yeah.
Right?
Yeah, there's going to be a lot more options for a lot more industries and businesses as we move forward. Because
one of the things you could probably make the argument with them is, as things, technology increases, competition increases, maybe you could start to see more fee structures get more worked into where maybe that goes from, because would you ever thought 250,000 would start to look at?
No, I wouldn't have. I always thought it was Fortune 500 companies that could only afford these types of programs.
million or more. Don't even look at it.
Right.
We saw the same thing in group healthcare, right? Where, if you didn't have 200 employees or more, it wasn't even worth looking at self-insured healthcare plans. Now I've seen plans that are 50 employees that work. So and I think that's all scalability in there too that goes with time. But what are we missing? Any industries that are exempt from this thing?
I've come across a few. Somebody sent me a blasting construction company the other day. That's not one that they're typically looking for because the severity could be quite high. Some of those.
We have some of those clients on our side though.
Yeah, that's absolutely right. You can definitely help them in some areas.
There's a lot of co-insurance deductibles in that lovely thing.
Yeah, property can be tough, especially in coastal areas. That can be difficult.
Have you seen a reprieve in property?
They keep saying it's coming. We are seeing some markets that will look at them, but it's still been tough. One of the issues, of course, is capacity. Some of these companies that come to us have quite a bit of limits in their property. And sometimes it just doesn't make sense. But we can definitely always look at it and see if it'll work and be part of the package we can put together.
Right.
But they do want to see more on the work comp, premiums, the GL, the auto is where they're really looking to see
because you
that.
can segment lines on this thing, right?
Absolutely.
Even if they have losses that are heavily in one line, we can exclude that one and put them in these other lines.
Absolutely, and you also have the ability to take on retentions differently in each line too. If you feel you could take on more on the work comp side, but not as much on the auto, we can take a smaller retention there.
So the program's pretty customized.
It definitely can be customized. Yeah, and it's definitely more customized than the traditional market. And your traditional market, like I said, is for the masses. And they don't always have the coverage forms that we can build into the the counter.
Well, and you need some unique coverages in your policy. Whatever class code they put you in doesn't. Yeah. Right. You see that a lot.
Yeah.
Or it helped with your pricing, so you can actually go with. Anyway. The games that get played.
Yes.
No, I think so here's the deal, guys. If you're listening to this, if you've got clients out there, or you are a client that are paying large sums of premiums, and you got good loss ratios, and if you haven't understood macro caps, I would definitely encourage you to reach out to Stephanie. Stephanie, how would they get a hold of you?
So we have a website, Retention Insurance Managers. You can look us up there, and we've got an intake form that'll just give us a little information about the business, what states they're working in, what they're paying for their premiums, where they think their loss ratios is, and what that is of course, a percentage of your premium versus the amount of claims that you've had.
So you kind of helps select.
Yeah, because they are looking for those best of class businesses that have less than a 40% loss ratio. They need to be in business for 5 years. They want to see that stability, and then have those risk control programs in place. So they fill that out. That gets emailed right to me. I can take a look, and then I'll reach out right away and set up a call and talk about what they're looking for and if we can help them.
Cool. Hey, so you're more than welcome to reach out to us as well here at SRA. Happy to coordinate a meeting with Stephanie just to see where you guys. And if you're a trusted advisor, if you want to learn more about it, I think Stephanie's. She's not. I would say real salesy, but she's she's a tactician. But she does sell because she educates. Anytime you can educate, you're selling. And I do think she's great at that, and she won't steer you wrong. I promise you that. So thanks for joining us today. Appreciate you guys taking the time to learn about this. And we're here to help in any way we can. So, and like I said, if you can't reach out to Stephanie through the website, definitely get a hold of us, and we're happy to connect you guys. So appreciate your time.
Thank you.